What's up guys, Adrian here and welcome to another video on passive income investing. So as a passive income investor, I've spent years looking for high yield stocks and funds in order to generate that income, and I will never stop looking. So individual stocks or REITs are obviously the classics, but nowadays we're pretty much spoiled for choice. You have closed-ended funds or investment trusts, which I simply call income funds, and of course ETFs, which are by far the most popular choice nowadays. I especially love covered call dividend ETFs since they have two income streams instead of one. I've covered them numerous times in other videos in my channel. But I also stumbled across a more rare and lesser known type of investment fund called a split corporation or a split share fund. So these funds are by far the highest yielding type of fund I've come across. They are a big part of my portfolio, currently generating about 30% of my overall income each month, even though they only represent about 16% of my investment. So how is that possible? Well, it took me a while to figure out exactly how these types of funds work and what the downsides are. But now I fully understand their potential and downsides, so I will share my knowledge with you in this video. So I'll start by describing what these funds are, how they're structured, and how they manage to pay out such a huge dividend every single month. I'll also go over the risks involved with these funds, and at the end, I'll review 3 or 4 of them so you could piece all the information together. Alright, so split corporations or split share funds are very similar to dividend ETFs. They typically hold a portfolio of dividend paying stocks. It could be 10 stocks, it could be 50 stocks, or even one stock, believe it or not. So it's called a split because there are two classes of shares. There's the preferred shares and there's the capital shares. Sometimes the capital shares are called Class A shares. So each type of share trades under their own stock symbol and has a separate NAV or net asset value, but more on the NAV a little later. So for example, a quick example, a popular split share fund in Canada is called Dividend 15 Corporation, and the preferred shares are listed with the stock symbol DFN.PR.A, and the capital shares are simply listed with the stock symbol DFN. So now I won't be talking too much about the preferred shares in this video because after analyzing a lot of the split share funds on the Canadian stock market, I came to the conclusion that investing in the preferred shares are simply not worth it. So like preferred shares in general, they're classified as fixed income securities, just like bonds. So the ones I analyzed tend to have a fixed dividend yield of about 5 to 5.5%. So in my opinion, you could easily find better value elsewhere, like with a covered call ETF if you're looking for high income. It's really the capital shares or the Class A shares that are interesting and have really high dividend yields. So how are these two types of shares funded, or how do they generate the dividends for us, the shareholders? Well, for the preferred shares, it's actually pretty simple. They are funded with the dividends from the dividend stocks within the actual portfolio. Also, in terms of stock price fluctuation, they tend to move very little. The capital shares, on the other hand, are funded by any leftover dividends after the preferred shareholders are taken care of, plus other income producing strategies that the fund manager uses. And the most common one is using covered calls. So I absolutely love the covered call strategy and own a lot of covered call ETFs. If you don't know what a covered call strategy is, check out my other videos where I discuss it in detail, but simply put, it's a zero risk strategy to boost the dividend yield. This is achieved by selling call options on the stocks within the portfolio. Not you, of course, the ETF manager takes care of that. So what's the difference then between covered call ETFs and split share funds? Why do split share funds, I'm talking about the Class A shares here, tend to have much higher dividend yields than the covered call ETFs? Well, the answer is leverage. The capital shares or Class A shares of a split corporation uses cheap leverage, which is borrowed money, taken out against the preferred shares in order to buy more shares for the fund. So more shares equals more dividend income. Add that to the covered call income and you get some really nice dividend yields. So 10 to 15% dividend yields or more are actually pretty common when it comes to the Class A shares of a split share fund. So in summary, split share funds were specifically designed for income investors who want to suck out as much income from a portfolio of dividend paying stocks as possible. My favorite way to describe them is covered call ETFs on steroids. They are definitely not meant for investors who want growth or capital appreciation. The same is actually true for covered call ETFs. So yes, you're making more dividend income, but you're limiting the capital appreciation potential when a covered call strategy is used. So these types of funds are definitely suited to pure income investors like myself who want consistent passive income each month. So since I just buy and hold stocks forever, which is what these funds were designed for, I really don't care about the stock price or the potential for the stock price in the future. All I care about is the income that they generate for me every month. So another quick thing I want to mention about these funds is that they usually have a termination date. It's typically about 5 years. This fact made me a bit hesitant at first when I was thinking of investing in them, but I then realized that the termination date simply gets extended all the time for most of the funds. So some split corporations that I own have been around since the late 90s and the early 2000s. So the termination date is simply nothing to even worry about in my opinion. All right, so now it's time to discuss the risk involved with these funds. There is essentially one but very important risk to explain, and this is what took me a while to understand fully. So like ETFs, the value of these funds, which changes daily with the stock market fluctuations, is tracked with a NAV or net asset value. You can typically see the NAV on the website for each of the fund, just like ETFs. So now the NAV of a split share fund is calculated by combining the value of both the preferred share and the Class A shares because they each have their own NAV. So combine the two and you have the unit NAV. So one unit NAV is equal to the NAV of one preferred share and one Class A share. And here's the catch. If the unit NAV of the fund is below a certain threshold, the Class A shares will not get the monthly dividend. The dividend will only be paid out if the NAV is equal to or higher than that NAV threshold. So almost all the split corps that I analyze actually have a NAV threshold or a NAV minimum of $15. It seems to be really the common number. I guess it's just the way that they're set up. Keep in mind that this rule does not apply to the preferred shares as they are a fixed amount. This rule only applies to the capital share. So what exactly does this mean in practical terms? Well, if the stock market goes down significantly, preferred shares of the split corporation won't be impacted much, but the Class A shares will be impacted significantly, and that's because of the leverage. Don't forget, leverage can enhance returns and capital appreciation, but also enhance losses and capital depreciation. So how many monthly dividends do split corporations typically miss? What is the success rate, if you will? Well, the answer is it depends. It depends heavily on the stocks within the portfolio. So dividend misses vary greatly from fund to fund. The more sector focused it is, the riskier it is as stock market sectors tend to follow each other. So I know that the possibility of missing dividend payments can be scary, but the good news is that it's actually pretty rare. So these funds are still very much worth considering in my opinion. I would definitely never invest all my money in split share funds, even though I thought about it many times because of the insane monthly income that I would get. Personally, I own about 8 of them, which make up about 18% of my total portfolio. So this is a percentage I personally feel comfortable with, and they are by far my biggest money makers. So I absolutely Love these funds. In terms of split corporations listed on the Canadian stock market or on the TSX, there are really two big providers. You have Quadravest Capital Management and Brompton Funds. So both are reputable asset management companies that have been around for decades. And there are other providers as well, but they tend to only have a very few or even one split share fund in their product lineup. So now it's time to analyze finally a few split corporations from different providers so you could actually piece all this information together. All right, guys, so the first split corporation I want to check out is from a company called Brompton Funds. So it's called the Brompton Split Bank Corp. The stock symbol is SBC for the Class A shares, you could see here, and SBC.PR.A for the preferred shares. So this split share fund holds the six big Canadian banks. So if we just look at the portfolio real quick, you have basically the Canadian big six banks, which is exactly what the description says here. You're investing in approximately equal weight portfolio of common shares of Canada's big six banks. So the stock price for here, August 6th, is $8.70. So the distribution or the dividend is 10 cents a month or $1.20 annually. So the distribution rates, by the way, for Class A shares actually never changes. It's always the same, and typically it's actually about $1.20, so 10 cents a month. And you could see that right now that's translating to an enormous distribution rate or dividend yield of 13.79%. So if you would buy shares of this split corporation right now, that's what you would get. So you see here what I was talking about before about the NAV and the unit NAV. So the NAV here is the NAV of the Class A shares. If we go to the preferred shares, just click here, the NAV is $10. So you combine the two NAVs and you will get the unit NAV, which is $18.03. So where does it talk about the NAV threshold or the NAV minimum? Well, you actually have to look pretty closely. So you see here where it says distribution, there's a little 1. If we scroll all the way down and look for that 1, it actually says it right here. No cash distribution will be paid out on the Class A shares if, after the payment of the distribution by the company, the NAV per unit, which is the unit NAV, so consisting of one Class A share and one preferred shares, would be less than $15. So there it is. So if this number here is anything under $15, it means that the Class A shares will not get the dividend for that month until the value of the portfolio reaches $15 or more. So that's the whole thing. That's the whole caveat with these funds. Now, looking at this one, how many dividends have they missed, if any? Well, if we go to, if I go to my TD web broker and I look at the chart, so this split corporation has been around since 2006, early 2006. How many dividends did they miss? Only 4 out of 176 months. And all 4 actually were in the period during the financial crisis or the Great Recession of 2008. You could see here. So September, October, November, and then it goes to April. So those are the 4 months that they missed, the months in there. And after that, until now, even with the recent stock market crash, they have not missed any dividends whatsoever. The second example I want to take a look at is a split corporation called Dividend 15 Split Corp. It's from a company called Quadravest. So like the name says, it holds 15 dividend companies in Canada. Stock symbol, by the way, is DFN for Class A shares and DFN.PR.A for the preferred shares. So it also, like the first split corporation, has the big 6 Canadian banks, but it's a little bit more diversified in terms of sector. You have some communication companies like Bell and Telus, and also some energy companies like, of course, Enbridge, TC Energy, etc. So a little bit more diversified, not all financial stocks, which I like about this one here. The website of Quadravest, by the way, is not as great as Brompton in my opinion, but you do have the NAV section here. So as of July 31st, it's a little bit delayed. These guys only update the NAV twice a month, at the end of the month and in the middle of a month, which is a bit annoying. But right now it's $14.94. So it's actually a little bit under the NAV minimum of $15. They don't talk about the NAV minimum or the NAV threshold on the website, but if you go to one of their press releases where they announce the monthly dividend, you could actually see it there, and you see it there right here. So no regular monthly distributions will be paid out on the Class A shares in any month, as long as the net asset value per unit is equal to or less than $15. So there it is. The NAV minimum is again $15, just like the first one. And the dividend, by the way, the annual dividend is $1.20 per year, or 10 cents a month, just like the first one as well. All right, so what's the dividend success rate for Dividend 15? Well, if we look at the chart, this one's actually been around a little bit longer than the first one we covered. It's been around since April 2004. So how many dividends did they miss? The answer is only 3 out of 195 months. So really good dividend success rate. They actually managed to not miss any dividends during the 2008-2009 recession. The only 3 dividend misses were actually because of the COVID market crash. So the 3 misses were March, April, and May 2020. You could see here the gap, and recently they started giving the dividend again of 10 cents per month. So hopefully they will keep giving it. I know that, like we saw, the NAV is very close to $15, but that's from July 31st, and in the first week of August the stock market went up significantly, so I have no doubt that they will. So this one right now is at $6.36. What does that mean? If you would invest in it right now, you would book a dividend yield of 18.87%, so even higher than the first one. Now that's a really crazy yield. You can see here that the annual dividend rate is also $1.20 like the first one, so 10 cents a month. So crazy 18, almost 19% yield on this one of my favorites for the corps. All right, the last example I want to take a look at is an interesting one because it only has one stock. It only has Enbridge. It's called the E-Split Corp. This is from a company called Middlefield Fund. So the stock symbol is ENS. So very interesting. You're basically leveraging your participation in just the regular stocks of Enbridge, and you're getting a really nice dividend for it. If we look at the NAV, you can see here, if you combine the two, it's $21, well over the $15 NAV minimum, which they also have. And this is a much more recent one. It's only been around for 2 years, so a really good option if you like Enbridge and want a lot more dividend yield. I'll show you what I'm talking about. So if you would invest in the Split Corporation, you would get a 13% yield. Right now, because the dividend is 1.56, and these guys have not missed any dividend payments yet. And just for fun, if we just go to the Enbridge, so if you would buy regular shares of Enbridge on their own, you would only get a dividend yield of 7.34%. So this is where the yield power of these split corporations come in. They even have some for one company instead of a portfolio of companies. It just means you're getting leverage exposure to the stocks in the portfolio, even if it's one company, as well as the covered call. So you're really sucking out a lot more income than owning the stocks individually. Okay, so hopefully now you understand how split corporation funds work and realize the huge dividend income you could get. The 5 main points I want you to remember when it comes to split corporations are the following. Number 1, they are designed specifically for income investors trying to squeeze out as much income as possible from a portfolio of high quality dividend paying stocks. Number 2, it's called a split because there are 2 classes of shares, each with their own stock symbol. So you have the preferred shares and the capital shares, which are sometimes called Class A shares. Number 3, the preferred shares are not worth looking at, in my opinion, as they are essentially like ordinary preferred shares and have a low fixed dividend yield. If you want consistent and safer income, it's much more lucrative to invest in covered call ETFs instead. Number 4, the capital shares or Class A shares is where the yield power is. Using leverage and covered calls, the fund is able to pay out really high dividend yields, in most cases are over 10% annually. And number 5, split corporations typically have a NAV threshold or a NAV minimum in order for the dividends to be paid out for the capital shares. So if you do decide to invest in split share funds, it's important that you analyze the stocks that are within the portfolio, analyze the dividend history as well as the total dividends paid out. This will give you a good sense of the dividend success rate and how risky it is. So every investor has a different risk tolerance. It's really up to you to decide which ones to invest in, if any. So I strongly suggest doing more research on your own if you are interested in split share funds. A great place to start is a nice short document by Brompton Funds explaining what a split share fund is in detail. So I'll put that link to that in the video description below. So now the $1 million question, which ones should you invest in? How many of them are there out there on the TSX? How do I get the full dividend history and success rate for each one? Well, once again, guys, don't worry, I got you covered. In my next video, which I'm working on right now, I'll go over my top 5 split corporations. And I won't stop there. I'll create a nice cheat sheet for you, like what I did for my favorite ETFs, where I put it all in a nice spreadsheet available for download. We got a lot of downloads and some donations for the ETFs and my portfolio spreadsheet, so thank you very much for those. Rest assured that even though they were very small amounts, they all went to good use. I basically invested it. So thanks for watching, guys. I really appreciate it. Give us a follow on Instagram, please, for bi-weekly posts on personal finance, investing for income, as well as stock picks. Also, please hit that like button if you learned something, and don't forget to subscribe. My mission is to help you make passive income. So take care, guys, and see you next time.